Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now is Nadia Lovell, Senior U.S. Equity Strategist at UBS Global Wealth Management. Nadia, we heard there that we've got a lot of speakers this week, not only Governors Bowman, Kugler, and Cook, but then Presidents Raphael Bostic and Austin Goolsbee. How do you see the Fed message evolving this week?
You know, it'll be interesting to see what the message is, because our sense was that this 50 basis points cut was something that Powell really wanted to get through, could not afford to see any potential further weakness in the labor market, especially given that monetary policy acts with a lag. I mean, we saw from the updated dots that it suggests that maybe some participants wanted a smaller cut. The medium dot did move up to 100 basis points, but you had 9 participants that are at 75 basis points or less for the rest of the year. But we know that, soft landed are hard and to navigate, and Powell wanted to get ahead of this. This is also about his legacy, and so he wanted to cut from a position of strength. Our core view has been since the July payrolls that we would get 100 basis points of cut this year, and that remains our stand. We continue to think that the disinflation is happening faster than the Fed was expected. We saw them reduce those numbers, and so we do think that the commentary this week probably will skew a little bit hawkish, just given where the dots are, and there's obviously dispersion on the committee.
Yeah, Chris Waller was saying Friday, I think, in an interview with CNBC that it was the favorable inflation data, not worries about the labor market, that convinced him to support that 50 basis point rate cut. So again, good news on inflation, not so much concern about the U.S. moving into recession. But with everything that we've been talking about, Nadia, I'm curious as to how it's affected the House strategy at UBS on putting money to work in the equity market.
I think last week was somewhat of a Goldilocks scenario for the markets. You got that sizable recalibration of cut, but also the macro data was pretty decent. And it feels like the bar for cuts going forward, is lower, and that boosts the probability of soft landing. So we think that that's overall supportive for risk assets. We're sort of in this environment again where market is probably back to good news is good news and bad news is good news. And so we think that along with the fact that you still have a corporate earnings environment that's broadening out, we think that it will continue to broaden out. That should be supportive for the equity market. So we think the equity markets can reach 6,200 by the middle of next year. And so we had been advising clients to continue to put money to work, particularly in high quality stocks.
Yeah, I think probably what you meant was good news is good news and bad news would be bad news. The economy is growing.
No, bad news is good news as well.
You think bad news is good news? Okay. Well,
yeah,
I'm sort of when I look at earnings, earnings are growing again after being stunted. The economy is growing moderately. It seems like if we judge the economy now, we can say, well, we're in a kind of soft landing position. So it does beg the question, I suppose, what comes next? Do we get better from here or do we get worse from here?
I think that we do continue to chug along here. Don't think that we do expect the economy to slow down from here. I mean, we're running at 2.9% if you look at Atlanta Fed GDP now for the third quarter. So we're looking for pace to slow down to somewhere closer to 2%, closer to trend line over the next 6 months. But at the same time, corporate earnings is accelerated, and that's because we're having that broaden out. We know that, much of the late last year into the first half of this year, that a lot of the growth was driven by tech companies, those mega cap tech companies. And now you're seeing some other parts of the economy of the S&P, the more cyclical areas are starting to see earnings grow again. And so that's going to help earnings accelerate. We're expecting, low double-digit earnings growth for the next 12 months, and that will be supportive to the overall market.
So are you advising clients to take a little out of some of that mega cap tech trade that you just identified there and maybe moving it into something that's a lower valuation and maybe more exposed to the economy?
So we have a balanced sector outlook continue to like tech for those secular tailwinds, particularly around AI. Also like financials as well for just that cyclical exposure and also the benefit of rates. And then on the defensive side, like utilities for the secular part of the story as well, particularly in power and up AI. So not necessarily saying that you have to sell your tech to move into the cyclical areas. Remember, there's a lot of cash sitting on the sidelines. We're seeing it among our own client space. So we're encouraging clients to move some of that cash off of the sideline and into the market, particularly in those higher quality areas of the market.
Yeah, so you mentioned housing recovery. You see that as well. I'm curious if the current positioning of the 10-year, I mean, it actually edged higher since the Fed rate cut. Whether or not, if that continues, we're at 374 on the 10-year now. How high does that go where you start to get nervous? Because, 30-year mortgages are generally priced off the 10-year, right?
Absolutely. I mean, we have expected 10-year to sort of come into like 3.85 by the end of the year. As you said, it is 30-year mortgage is more tied to the 10-year. You're seeing, so we don't expect the 10-year to move much higher from here. We do expect mortgage rates to sort of continue to come down as well. And that should be supportive for the housing market. We know that the housing market hasn't been a demand issue. It's been a supply issue. A lot of people are locked into very low mortgage rates. And so we think that should help also some housing turnover, which should be supportive to all of those companies that are in the housing ecosystem.
So when you sit down and you listen to what some of the other strategists over at UBS are saying about the degree to which the election in the fall is going to have an impact on markets, what are they saying?
So we think that is a very close call. I mean, we give a probability of a Harris win 55% and a Trump victory 45%. What we've been advising clients to do is to not make any major changes to their asset allocation on account of the election. But at the same time, of course, there are some clients who are concerned about a pickup in volatility. So we've been advising hedging strategy, particularly clients that have exposure to stocks that might be more sensitive to the election. So think about those stocks that might be exposed to tariffs should former President Trump wins, or some of the stocks that are financials could benefit from a Trump victory. And then on the other side, in the Harris sort of victory, then you have those green energy stocks that could benefit. So we've been advising clients to do things on the margins and not make any major changes.
Nadia, if Harris wins, we'll likely see changes to corporate taxes. They'll eventually be higher than now. Is it simply mathematics that will cut into profits?
Absolutely. I mean, Harris has proposed 28% to corporate tax rate versus 21% today. And also even the buybacks, lifting the buybacks from 1% rate to a 4% tax rate. And so when you think about that, that could be like a mid-single digit hit to corporate profits. And so that will probably have a drag on the market as well. So something to watch.
Nadia, thank you for joining us. Nadia Lovell there, Senior U.S. Equity Strategist over at UBS Global Wealth Management. Bill Adams, Chief Economist for Comerica Bank, joins us now to discuss conditions underlying in the U.S. economy. Bill, thank you for being with us. One of the trends that we've seen since the Fed made that big rate cut is a steepening of the yield curve. Does the action by the Fed almost guarantee that we'll continue to see this play out over the coming weeks? And what are the implications of a steeper yield curve?
I think the steeper yield curve is a sign that the monetary stance in the United States is getting back towards normal after a very restrictive period. So economists, market strategists, we've been talking ad nauseum over the last couple of years about the inverted yield curve as a recession signal. And the uninversion of the yield curve often is seen as a warning sign for equities, because in cycles when the inverted yield curve is followed by a recession, this is the point where the Fed is cutting, that uninverts the yield curve, and that's the sign that the recession is beginning. This time, knock on wood, I feel looks different so far. It looks like the Fed is cutting largely because inflation is coming back to the Fed's target, and that's quite good news for the economy. And good news for risk assets as well.
So do you think the Fed, in cutting by 50 basis points last week, was declaring victory?
I think the 50 basis point cut was in part a reaction to expectations for lower inflation over the next couple of months' readings. We've seen a move lower in energy prices, and in part due to solid supply and weak demand globally, especially Europe and Asia. And that's going to translate into lower headline inflation in the next couple of months. And the Fed doesn't want inflation-adjusted interest rates to be rising at this point because the unemployment rate's already a little higher. There's a margin of slack in the job market, and inflation is closer to their target, so there's not as much of a case for tight monetary policy. So I think there's an element of moving because of the inflation outlook. I think also the big downward revisions to the jobs data released over the month of August and into the beginning of September really changed the picture about the labor market. The labor market had looked really solid when the Fed last met in July. The 12-month moving average of payrolls growth was 218,000 with the data in hand on July 31st. As of the September meeting, that 12-month average was down to, I think, 157,000. So a very different picture, much cooler labor market, justifying a move away from restrictive and back towards neutral monetary policy.
But Bill, it still feels pretty good with where we're at with the U.S. economy, and sometimes, when you see the Fed cutting interest rates into an economy that's performing pretty well, you start to get nervous about things being too good, so as long as we're feeling nervous and feeling a little guilty, what do we worry about the most, or what do you worry about the most?
Well, it's our jobs to worry, right? So
yeah.
In terms of the things I worry about right now, top of mind is the global energy supply with wars in the Mideast, war in Ukraine. If we saw an interruption to energy supply, see WTI jump to $150, $200 a barrel, that would be a major blow to the U.S. economy. I think the other downside risk to the U.S. economy that we've been talking about over the course of the year, some of them are these sort of long bubbling issues like the commercial real estate in large big city downtowns. Think, San Francisco, Manhattan, Chicago. But that issue also seems like it's getting better understood, and also with interest rates moving down faster than had seemed likely to be the case a couple of months ago, I think that is going to be a bit of a cushion for real estate. So a lot of the interest rate sensitive downside risks to the U.S. economy look less concerning now, given the change in the Fed's outlook.
So, as you know, last week, Powell was talking about recalibrating Fed policy to a more neutral level. Do you have a sense of where neutral is? What's the neutral rate in your work?
Neutral is lower than where we are today.
Yeah. Okay.
So it's not 4 3/4. It's probably not 4. It's probably not 3.5. Maybe it's 3. Maybe it's 2.5. Maybe could be somewhere in there. I have penciled in lightly a neutral rate of between 2.5% and 3% in my forecast. But it's a very academic discussion right now because it doesn't look like interest rates are headed back to neutral in the near term. It's not a 2025 story. Now, if this soft landing dynamic turns into a more serious economic downturn, then the Fed could be cutting more aggressively. And would they cut down to quote unquote neutral very quickly? Would they go past neutral into expansionary territory? I think that's a possibility. It's not my base case. But I think the question of where is neutral, it's not an issue that we have to be able to answer right away.
Well, even if we can't pinpoint it, it seems reasonable to say that it's a little higher than it was before. You're talking about, maybe 2.5% to 3%, even maybe a little above 3%. So it does beg the question, and let's have that academic discussion. Why are we operating at a higher level? Why is the economy on a stronger footing now than it has traditionally been over the past many years?
I think about the neutral interest rate in the context of the overall economic policy mix, meaning you have monetary policy on the one hand and fiscal policy on the other hand. We had tight fiscal policy for the many years after the Great Recession. Fiscal policy became more expansionary towards the end of the long expansion of the 2010s, but still not like we have today. Right now, the U.S., we have a fiscal deficit of about 6% of GDP. And we also have pretty expansionary fiscal policy at the state and local government level. State and local governments have been pulling in a lot of tax revenue because of higher property prices, so higher property tax revenues. And there is still the long lag of all of the money that got to state and local governments during the pandemic. So there's a lot of fiscal support, and that means that there's less need or less of an argument for monetary policy to be supporting the expansion.
We talked.
Oh, sorry, go ahead.
No, I was just, we talked about the PCE. Other data that we're expecting this week includes personal spending and income. What's your sense of the American consumer right now and the reaction function that consumers may have to lower interest rates, this last rate cut?
I think the average of what drives consumer spending in the United States is in pretty good shape. American consumers are supported by big increases in household wealth. Many Americans locked in low mortgage rates in the kind of pre-2022 years, and that's supported a lot of consumer spending. You also have half of bachelor's degree workers have some remote work, so they spend less on commuting, et cetera. So that is, I think, a big buffer for consumer spending. Now, the typical American, think the median, is not as well off as the average. And so there's more of a drag from the cost of living, from the big increase in rents. You have more people affected by the expense of buying a new home with higher mortgage rates, higher prices. And that's, I think, why you've seen the signs of consumer stress, like higher credit card delinquency rates in the Fed's data in the last couple of quarters.
Bill, thank you for being with us. Bill Adams, Chief Economist at Comerica Bank. We welcome Chuck Cumello, President and Chief Executive Officer at Essex Financial. Chuck, U.S. stocks look pretty good here with the S&P 500 up around 5,700. If you look at the 200-day moving average, it's just below 5,200. In other words, you could get a big pullback. The uptrend would still be in place, but people would be feeling a little nervous. How do you feel about the current valuation levels?
Well, thank you so much for having me. Listen, I think the market, valuations certainly are a little bit elevated in some cases, to put it mildly. But, we're anticipating an awful lot of volatility as we enter and get closer to this election that essentially I think nobody's looking forward to. But listen, we are bullish on the market. Interest rates coming down tends to be a good thing, although that can be a wild card, which we can go into a little bit if you'd like, as well as earnings are pretty well. The economy and the entire reason the Fed made the move that they did is around employment, and employment has been slowing. It's still good. It's not as good as it was. So, again, they got themselves a little bit ahead of it.
So in terms of further easing, how much are you expecting between, let's say, now and the end of the year?
Probably at least one, maybe two. I mean, I think the Fed, has been quite repetitive and quite on the record with them being data dependent. And we're going to have, as you just mentioned in the update, we're going to have the PCE coming out later this week. We'll have another employment report or two before these next two Fed meetings in November and December. So certainly, I think probably one, possibly two, depending upon how employment looks and obviously inflation.
So when you look at the high PE companies, the biggest tech stocks, they generally perform well when rates come down because they're long duration assets and it's just a better environment. And that's kind of on a technical level, but on a real level for the other 493 in the S&P 500, they benefit from having their costs come down. They don't have huge profits and they don't have huge profit margins. So when rates come down, it's good, right? So in that sense, things are looking pretty solid.
Well, that's the thing. You think about how some of those high valuation tech stocks did in a rising interest rate environment.
Yeah.
So that. But you're 100% right. The other 493 companies, especially for small caps, and obviously a lot of different sectors outside of technology, lower interest rates are a boon across everywhere, and from cost inputs to just their cost of doing business, and then again driving the economy is the U.S. consumer, which drives 2/3 of it. So a lower interest rate environment is always a better environment than when the Fed is hiking rates to slow the economy. But the technology companies, again, they have ceded leadership, right? I mean, they certainly, the only stock that in that Magnificent Seven that has hit a new 52-week high is Meta. Apple, Microsoft, NVIDIA, Google, Amazon, Tesla haven't. S&P 500 has. The S&P equal weight has. As a matter of fact, over the past, I think it's past 90 days, give or take, the RSP equal weight is up up 8.21%. And S&P 500 up only 4.46%. So you are starting to see this market broaden. And again, I think that speaks to the point you just the point that you just mentioned around the overall economic environment is more conducive to a wider range of companies.
Chuck, imagine a world where Kamala Harris is the next U.S. president and the corporate tax rate goes up to 28%. What do you do then?
Yeah, so that's that's the obvious wild card, and why I said before we're looking for a lot of volatility. Now, I think part of that is blocked a tad bit if you get a Democratic president and you get a Republican Senate. That's why, from all the things that we see and listen to and read from a lot of really smart people, a Democratic sweep, I think for the markets would be challenging, to put it mildly. But listen, I mean, companies have managed around higher tax rates in the past. They can in the future. It certainly is another headwind to it. But again, U.S. companies, the U.S. economy has proven itself extremely resilient in the past. I have no doubt it will do so in the future. But obviously that would certainly be a bigger headwind, and would certainly cause some things into question.
So I want to put a question to you, which is kind of extrapolating from point A to point B. We've kind of made the case that you're seeing a nice spreading out of the market in the United States. In the same way, should we see a spreading out of investment buying into emerging markets, into the less developed markets? Does that look good going forward into the end of this year?
Well, it's always good for U.S. investor to be diversified in other markets other than the U.S. But the challenge has been is in the past you'd have this rotation where the U.S. markets would do really, really well, and they would sort of suffer a little bit, and then international markets would come roaring back. You just haven't seen that, and the returns have been so compelling. Like roughly over the past 3 years, the S&P 500 is up about 33%, and the IFA index is up 11.4. Emerging markets is negative 8.69. So it's a tough sell, but I think that's where you have to find the right manager as well, whether it's an active ETF or whether it's a mutual fund or pick an individual stock. There's such a wide variety, but it's a tough sell getting the average U.S. consumer investor, to put money into emerging markets, given the opportunities right here at home. But they can certainly provide some outside returns if you get it right.
Chuck, very quickly, September, October can be rough months for the equity market. Looks like we'll get through September perhaps unscathed. Is there a risk of a lot more downside in October very quickly?
I think there is. I mean, September, remember how we started with August? That was a tough start to the month. We finished strong. September looks like it's going to be pretty good, but we're trying to tee our clients up for, expect volatility. It's going to provide opportunity for investors as well. But, we try to get ahead of it so that when it does happen, people don't, completely freak out and get too nervous.
Okay. Thank you, Chuck. Out of time, but we appreciate it. Chuck Cumello, President, Chief Executive Officer at Essex Financial.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.